Are you guys seeing my screen?
Yeah, cool. Anyway, good morning to everybody. This is Dr. Sudhakar, General Guard President, AIPI. Today we have a stalwarts on pre-IPO. They're going to talk, and they're going to talk at least 3 more webinars to educate us about the pre-IPOs and also they have some offers. And API, we're trying to tune our webinars in different directions. I know you had a lot of COVID webinars and scientific webinars. We need to learn more of the investment webinars too. So this is going to be the future, and I'm sure Dr. Gottumakala, will also pretty much able to do all these webinars next year once we take over after July. Today, I'm going to introduce one of the stalwarts of the 3. His name is Kalyan K. Kalyan is a co-founder of Vibhu Venture Partners. He had an 18+ year experience in top industrial and technology companies of the world, experts in cloud and SaaS field from the Seattle area, builds hyperscale clouds for the living, a product leader running global program and partnership with the tens of millions of budget, hundreds of millions in revenue. Learned evaluating companies and opportunities from his dad, who is now a retired general manager responsible for the reviewing and approving loans for the small and medium scale businesses at the biggest Bank of India, and now combines it with the experience of leading enterprise cloud partnership to form a reinvestment thesis. He has been angel investor for the last 10 years and pre-IPO investors for the last several years. Very well, we really need some education, gentlemen. So start with the basics. Somebody like me, I don't know much about pre-IPOs, and educate us. Definitely, you are dealing with one of the best crowd in the world. Good luck. Thank you.
Thank you. Thank you, Andy. Can you guys hear me?
Yes.
Awesome. Thank you for this introduction. I'll introduce the rest of my team. One of my co-founder who is leading the presentation today is Satya Anantu. He's also a tech leader, worked at Amazon, worked at Yahoo, and now works at another tech chain that is very popular for its search. So you probably know which one it is. He leads engineering teams that build products there. He has been a very active participant in angel conferences and has led many angel investment theses before. So he is bringing his tech experience and his investment experience to the table for us. The second co-founder I have here is Shankara Manepalli Garu. He is also a tech leader. He was a founding member of one of the companies that was acquired by Cisco, and he spent a significant amount of time at Cisco running products and major programs. He's now an entrepreneur, does social impact entrepreneurship, runs Sky Schools, which is nonprofit. He also has a lot of passion for art of living. He's an art of living teacher, and for organic farming. He also he's a graduate from IIT and Kellogg's. So he brings a lot of perspectives from his life into value investing. So today we are going to talk about what we think is one of the hottest classes of investing that is available. Like you rightly called out, in this space, what we think is there is a lot of opportunity, but lack of awareness. So Team Vibhu is here to happily bring education to you and also bring awareness on the opportunities that exist in the market. There are additional topics we cover today, which is primarily about how do you analyze these opportunities, when do you actually look at investing in some of these opportunities. That's about 30 to 45 minutes of content we will cover today. During the course of the content, at least two of us will be happy to take your questions on the chat. And after the content is complete, we will definitely stay on to answer all your questions. This is, I'm assuming this is the first time for some of you. So there should be a lot of questions. So we are happy to answer all of our questions, and we have structured the content for people who are new to this, and also has enough information for people who are experts at it. We're also in the process of launching our new funds, which will give you very interesting opportunities in the very short term to start with. And we also will tell you about how to join our group so that you can join our group as an investor, keep your ear and eyes open for all the opportunities that are showing up, and take part of some of these exciting opportunities as you go. With that, I will hand it over to Satya. Like I said, during the course of the presentation, please feel free to use the chat window. We will be answering, at least two of us will be answering questions during the presentation in the chat window. And after that, we will have a dedicated Q&A time. Thank you, everyone, for making it this morning.
Thank you. Thank you, Dr. Sudhakar Garu, for the introduction, and Kalyan. Our participants just hit 100, so good start. So I'll get started. This is Satya. Today I would like to talk to you about the different kinds of investments in startups and why pre-IPO is the hottest class right now. So before I say anything, this is a group of doctors, so thank you very much for fighting COVID-19. Without you, we would not be doing all of this and be safe and healthy. So thank you very much. So this is investment related and money related. So we'd like to put our disclaimer before we talk anything about investments. Startup investments are available only for accredited investors. I believe most of this group, if not all, are accredited investors. And startup investments are private placements. They carry high degree of risk, both in terms of how the investment will do, and there is also some transaction risk, which we'll talk about a little bit later. One of the important things in this space is private companies are not obligated to share financial information. They're not obligated to share regular quarterly reports or anything like that. So that increases the amount of risk in these investments as well. This is not a financial advice. You should talk to your own financial advisor to check whether this is the right kind of investment for you or not. And lastly, should you decide to invest with us, please review all the fund documents carefully before you make an investment decision. So this is what we are going to talk about today. Life cycle of a startup. What are the primary ways to invest in startup? What is pre-IPO asset class or secondaries? And then we'll introduce the funds we are raising now to invest in pre-IPO asset classes. And we'll let you know how to participate in our fund, followed by Q&A. So we'll start with the life cycle of a startup. How does a startup work? I'm sure many of you would have invested in startups at very early stages. So I'll quickly go through this. So before you invest in any startup, you first have to figure out whether it is a startup or not. How do you figure that out? At the core of any startup is the scalable business model. If there is no scalable business model, it's not a startup. Taking in the medical field itself, yes, medicine is a service. However, you need money to sustain and provide that service. So if you compare a doctor having a small clinic versus Apollo Hospitals, which has a lot of hospitals, which is a better investment for you? Just purely looking from money perspective. Obviously, Apollo Hospitals is a better investment for you. So that is the kind of thing we are talking about here. There might be a small one-person thing, company that is trying to do something, provide a niche service, and that pays their bills and stuff like that. That cannot be a startup. Tech startups are much bigger and they have much wider scope than that. So that's the key difference we are talking about. One of the examples I could use here is when reviewing these applications for angel investments, we came across an application where a yoga teacher, she set up her own website, and her specialty is to provide yoga classes for pregnant women. So do I call that a startup and invest in that? No, I won't, because it hinges on one person, it hinges on one niche skill, and it cannot scale beyond that one person very easily unless they have a strong business model. So that's the key difference between a startup and a lifestyle business. So that's one thing you need to keep in your mind when you're investing in startups. So what are the different stages of startups, right? Maybe one or two people, they have an idea, they start a company, they have founded the company, and then they go to friends and family for investment. They develop the product a little bit, they have a prototype, and then they go to external investors. It could be angel investors at pre-seed and seed stage here, right here. So this is very high risk area. The product is just being built. They don't know whether it will be successful or not. So this is the area where angel investors works. And then when the product develops a little bit, the company might go to venture capitalists and raise more money here and really scale the company. So the red curve here shows the revenue of the company. How does the revenue of the company grow over time? During the initial phases, there are more expenses than what revenue the company generates, and many of the companies take a long time to break even and get to a positive thing. Some companies take even longer, and during this process, many companies die. They die in the beginning stage because they don't have a strong business model. They don't have a strong revenue model. They cannot get more revenue than their expenses, and many companies die. Some companies survive a little longer and then they die. So let's say a company goes through all this phase and really survives, and then it can be successful, right? So angel investors are the investors who invest in the beginning stages of the company when the risk is super high. As high net worth individuals, you might have come across some early stage companies and invested in those companies. The risk is super high. Recently, I saw a company, I talked to a company that is in the business of making COVID testing kits. So the biggest impediment for them is getting approval for that COVID testing kits. So there are big risks there. They have to get approval, and then the price point has to be competitive in the market, and it has to sell in the market. So those are angel investors. Those are on the mind of angel investors when they are making these kind of investments. Talking about tech companies, the product can be very small. There might be very few users that are just trying to establish their product, and it's going to be a long way for them. Once the product establishes itself in the market a little bit, then venture capitalists show up and they invest in these startups to really scale them. Once Series C, Series D happens, which means the startup maybe is 4 or 5 years old already, then growth and late stage VCs come and invest in these companies. Now we saw from an investor's perspective, angel investors invest very early. VCs come in a little later into the startup. These are the primary ways to invest in the startup. How do they get their money back? Either the company gets bought when it is really small by a bigger company, often called acqui-hire. They are not really interested in the product, they are interested in the people. And if the company is a little bigger, corporate merger and acquisitions happen. Big corporates buy smaller companies so that they can expand their product line and revenue. And if the company is much larger, like $1 billion, $10 billion, then they look at going to IPO. So this is overall the life cycle of a startup. There are different actors coming in at different phases of it. So we have seen the valley of death here. The risk is so high in the early days. But why do angel investors invest in early stage startups when the risk is so high? The key reason is being connected to innovators. So the graph on the right, it's I'm sure you would have seen it before, law of diffusion of innovation. Only 2.5% of our society are innovators. And on the left side, you see the income graph in the United States. The numbers may have changed a little bit now. This is a somewhat older graph. About 5 to 10% of the US population are high income accredited investors. So on one side, you have people that have a good amount of money, and on the other side, there are very few innovators that are innovating in their respective fields. You want to support each other. That's the main reason angel investors invest in these startups, and they want to be connected with the innovation. They want to be supporting innovation, and in the process, they want to learn from these founders and new companies that are cropping up, and also give to them from their experience. For example, if there is a new a medical related company, there are many senior doctors here. So maybe you could teach them something, mentor them, or help them build that company. So that is the key reason for early stage investments, even though the risk is super high. And how do you mitigate high risk in this space? You build a portfolio of companies. You just don't invest in one company and hope it will be widely successful and give you financial returns. So on the right, you see a list of a funnel of tech companies. So these are the companies that got seed funding in 2008, 9, and 10. 3 years, around 1,120 companies got US seed funding in the tech world. So that's a sizable number. But how many companies survived and reached $1 billion market valuation? Only 12 companies reached that stage. So when you're investing early in the life cycle of the startup, you don't know how far your company will get. So that is the reason you need to build a portfolio in the early stage. So on the left, you see a table. Let's say you invested $10 you decided to invest $10 in early stage companies and $1 each in one company, right? So no matter how smart you are, how you pick your companies, 7 companies are just going to fail. They don't return. 4 companies will just shut down, they die. 3 companies, they don't do very well financially, so they might just give you dollar on dollar, nothing more. 2 companies may do better and they return 5x of your investment. But there is that one company which might return 10x. So that company is a company which reaches the 4th round here. If one of your companies reaches the 4th round here, that might return $10 on a dollar, right? So what if one of those companies reached the 6th round here? You might get $100 on a dollar return. So your average return would be 11.3x. What if one of your companies reached the $1 billion unicorn status? Unicorn is a term used in Silicon Valley, which means the company has reached $1 billion in valuation. So if one of your investments, early stage investments, reaches unicorn status, you might very well be looking at 1000x return, right? And your average return over your portfolio becomes 100x. So it all depends on what kind of companies you pick and how well that one winner does. So we talked about the life cycle of a startup. So the primary ways to invest in startup, either you invest in the beginning as an angel investor at the top of the funnel. You invest in a lot of companies, and some will fail, some will win. And the ways to invest in that is you go to an angel group, you go to an angel network, accelerators, and angel funds. There are different ways to invest in that. Or if you want to invest when the company becomes a little bigger in this area, you go to VC funds or PE funds, which are mostly available to institutional investors. But if you have good network with VCs, they might let you in and let you invest in these companies. So those are the primary ways to invest in startups. This is how it has been so far, but new ways have opened up to invest in startups after they become big. If you don't want to take risk in the early stages, that's what we are going to talk about for the rest of the presentation. So before we get there, I would like to talk about Vibhu, our team. We talked about our team, myself, Kalyan, and Shankara. So we three came together to form Vibhu with a goal of bringing these investments to a wider audience, wider investor base. How we evolved: we started in 2018, myself and Kalyan discussing about investments, how to do these startup investments, what are the different things we need to look at while investing in startups. And in 2019, the group became bigger. And we made this group, we raised a fund, 6-digit fund, and invested in pre-IPO companies. If you are familiar with the tech space, you might have heard about DoorDash, Palantir, Wish, Robinhood, Unity, Marqeta, Snowflake, Tanium, Airbnb, all of these names. So we invested through our fund in all of those companies. That was a trail run for us in 2019. And in 2020, we formally formed a brand, Tech Unicorns, and we invested in SpaceX. This is a seven-digit multi-million-dollar fund, which invested in SpaceX. In 2021, we rebranded. 2 reasons. We don't want to be limited to tech only in the future. And as I said, unicorn means a company that has $1 billion valuation. We don't want to limit it to that either. So we rebranded, which is more connected to the Indian ethos and also widens our perspective. So that's our evolution. So what we do, we focus on 2 things. One, top of the funnel, high risk, high reward investments, early stage investments. So we invest in pre-seed, seed, and Series A companies when they are very small, so that you can help those companies and also enjoy the high risk reward ratio there. The risk is high, the rewards also can be huge. One example I could use here is most of us would have used Uber at some point. So an angel investor that invested in Uber in the early days when it is at seed stage, this person invested $5,000 in Uber when it was a seed stage company. At IPO, that $5,000 was worth $25 million. There is no other asset class that gives you that kind of appreciation. So imagine you picking the right company and investing $5,000. 10 years later, that becomes $25 million. That's huge. But does it happen with all the companies you invest in? No. It happens once in a blue moon. So that's the trick. How do you pick the right companies and find the right founders and invest in those companies? So that's one area we work in. The other area we work in is very big companies. We do pre-IPO investments or late stage secondary investments in companies that are either $1 billion in valuation or very close to $1 billion in valuation. So we invest in these 2 areas. We talked about early stage investing. We will talk about pre-IPO investments as well. So coming to the pre-IPO asset class, we talked about 2 primary ways of investing, right? Either you invest in early stage or you go to VC funds and let the VCs invest in the company. So by primary, I mean you are directly buying shares from the company. This is secondary asset class. Pre-IPO asset class is about, who is holding the shares right now, you go buy shares from them. It could be early angel investors who already are sitting on 10x, 20x returns, or it could be employees who want some liquidity and they want to sell their shares of the startup, or it could be VCs where their fund is shutting down or they have good return multiple and they want to dispose of shares. So that is where we get our shares from. So one case study here, I don't know how many of you invested in Snowflake. It's a tech company. They provide databases as a service, software as a service. So Warren Buffett bought Snowflake at IPO for $120. So this created a lot of buzz in the stock market. Warren Buffett is investing in a tech company. He hasn't invested in a lot of tech companies, right? So this must be important if Warren Buffett is coming and investing in this company. So that created somewhat of a buzz. And you guys know how IPOs work. These big institutional, these big banks, they go to institutional investors and they sell stock to institutional investors. On day one, when the stock listed, it went to $245. Warren Buffett is a smart man. One day he made double the money, right? That's great. And if you were following this news and you thought Snowflake is up to something, maybe you invested on day one. You bought it for $245. And where did it peak? It peaked at $390. There are many FOMO investors, fear of missing out. They want to get in at any cost. They might have bought at this price because they don't want to miss out on the opportunity. And then it settled back at $235 today. If you want to buy it today, you buy it at $235. So look at this wide range from IPO $120 to $390 and then back to $235. So yes, Warren Buffett doubled or tripled his money in a few months. But what do we do as we go to angel investors and VCs who are very early investors in the company, and we buy stock from them. We bought it at $30 in 2019. So that's the difference. So we identify the right companies and buy stock in those companies early so that we go with a long-term view and not short-term speculative mode. We always have this long-term lens on any investment. And this may sound too good to be true, but what is the catch here? Because you are buying early, you are buying from insiders, you are buying from existing investors. You cannot sell this stock until 6 months after IPO. That's the only catch here. So you can get into a company early, you can buy from early investors and employees of the company, but you have to hold until 6 months after the IPO. Apart from that, there is no other catch here. That's the real catch, right? So look at this, Warren Buffett, we entered at a lower cost basis than Warren Buffett entered. That's the whole idea here. So why is it so hard these days? Why wasn't this happening before? There is a trend change in the startup industry. At the height of .com bubble, if you guys have been in the US at that time, every tech company was going IPO. 5-year-old company, they would go IPO, right? But recently, this trend has changed, and the companies are waiting for 10 years before going public. So they are spending a lot of time in the private space before going public. And how do they survive? They have access to capital from institutional investors, from private equity funds, from venture capitalists. They have a lot of money that is waiting to be invested in these startups. So the graph on the left, Apple, Microsoft, Oracle, Amazon, all these companies, they generated a lot of value after going public, after being listed in the stock market. But if you look at recent examples, all the value is generated before they went public. That means in the private space. You look at Snowflake, it went all the way from $30 to $120, even before it went IPO, right? So that's the growth we are talking about in the private space. The growth is happening before the companies go public, and after they become public, there might be only very little growth left in that company. So this is the reason we want to invest early in these companies, find the right opportunities, and invest early in these companies. So this is how an ideal startup would look like. In the early days, angel investors invest in the startup, and then venture capitalists come in, grow the company. At some point, an inflection point occurs. The time for hyper scaling the company comes. The company grows leaps and bounds. So the ideal entry for us is right here. when we think the company is going to scale very rapidly and increase in market value. So this is the place where we want to enter. This is our goal, to find the companies at the right spot and invest in them so that you can enjoy this high growth. Will we be successful in all the companies? No, we will make some mistakes, and some companies may not grow as expected, or they might lose value over time. But how much we maximize this possibility is the idea of building a portfolio of these assets, right? And then after IPO, as I told you, have to hold it for 6 months. You cannot sell it for 6 months. It's locked up for 6 months. So in this 6 months, anything could happen. If the company is great, it'll increase. It'll keep increasing. If the company is not great, it'll keep decreasing. The case where it decreased is Uber and Lyft. They lost value after IPO. The case where it is increasing is Snowflake, Airbnb, Unity, all of these companies, they have increased after IPO. So building a portfolio is key here. So now you have seen those, some of the recent examples. Snowflake, at peak, it gave about 10x return. Probably it will give us about 8 to 10x of return when the lockup period expires. One Medical, you are all in the medical profession. You would have heard about One Medical. They're building primary care clinics and tying up with corporates and insurances to provide primary care to that audience. So it was 1x. I personally invested in it, and it became 3x after at IPO. And when the lockup period expired, I think soon after that, it became 4x and even 5x at some point. Unity, 1x, 7x multiple for pre-IPO investors. So this is the range of returns we are looking at. There could be companies like this. I personally invested in this company. It is one of the video conferencing tools, but Zoom totally took away most of the video conferencing market, and these guys lost value. So I got only 40 cents back on the dollar. There could be that kind of companies as well. That is the reason building a portfolio is important. So just like the stock market, there are two ways you could go about doing this. You could, if you know about a company really well, you could buy stock in that one company. The risk is concentrated in that one company, and you have to do the due diligence to invest in that company. And it could also be difficult to get access if you go company by company. If you are a savvy investor and you know how to invest in pre-IPOs, where to find them, and time it right, this might be the right strategy for you. If you want to be a passive investor, the strategy is to invest in a fund. A lot of people, maybe 50 to 100 investors, they get into a fund, and the fund manager manages the fund and finds these right opportunities and invest in them. It becomes a passive investment for you, and you get exposure to a pre-IPO asset class. The good thing about the fund is, one, it diversifies, so that even if you make a mistake with one company, another company will pay it off. And the due diligence is done by the fund manager. You don't need to be actively pursuing these deals. And also with higher numbers, the access becomes easier. When I go to a VC or angel investor on an employee, there is a difference when I'm seeking to buy a $20,000 worth of stock versus $250,000 or $500,000 worth of stock. So it gives us better access when we go together with a bigger number. So with that, we saw the background about early stage investing, background about pre-IPO investing. So we are raising funds for in the pre-IPO space. We'll talk about those funds. Our mission is simple. We want to find high potential private companies, invest in them to generate market beating returns. How do we identify those companies? We'll talk about a little bit. How do we get access to those companies? I talked about that already. We go to venture capitalists, we go to early employees, we go to angel investors, buy stock from them, and we invest in our pre-IPO funds. We patiently hold it until IPO happens. And in most cases, 6 months after IPO, we can sell those stock. So The tech world is very wide. It's super wide. There are a lot of companies. What areas do we focus on? We focus on the transformational companies. Every industry, it sees a 0 to 1 company from time to time. If it is space, it's SpaceX. If it is payments, it's Stripe. If it is e-commerce, it's Amazon. And there are more disruptors like Shopify now. So there are transformational companies in each and every industry. That is one focus area for us. And the other focus area for us is cloud. Every industry, every enterprise is moving to the cloud. And by moving to the cloud, they are saving money on their operations, and they also can scale quickly. They don't need to be tied to one data center or one provider, one software. They can use a lot and scale very quickly. And there is also some developments in the tech world. Moore's law, which was very dearly held by semiconductor industry, that is becoming less and less relevant, which means the tech industry has to spend more money on scaling the infrastructure going forward. The other focus area for us is consumer and lifestyle brands. This could be an Uber, this could be a Lyft, this could be Instacart, where during COVID they saw very hyper growth because people did not want to go out, and they're ordering deliveries through Instacart. Costco uses Instacart, right? So the consumer lifestyle, it rapidly evolves over time, and there are new brands cropping up in this space. And the last one is fintech and blockchain. The finance industry is also going through a lot of transformation, both due to technology and due to blockchain technology specifically. So that is one area for us to be focused on. So these are the 4 areas we are looking at, and our funds are spread across these areas. We are raising 3 different funds with different investment objective. The first fund is Cloud Plus Fund. This will purely invest in cloud companies and transformational companies. 100% of the money you put in that fund. And each fund invests in 10 to 20 companies. It doesn't go into single company. This is to spread risk and get exposure to more companies. The second fund is Consumer Plus Fund, which invests 60 to 70% of the fund is invested in cloud and transformational companies. 30 to 40% of the fund is invested in consumer and lifestyle companies. So that's the mix of the second fund. The third fund is FinTech Plus Fund. A similar thing, 60 to 70% is invested in cloud and transformational companies. 30 to 40% is invested in FinTech and blockchain companies. So these are the 3 different funds. Depending on which space or which segment you want to invest in, you could pick one of these funds. We talked about our team. So the investment committee comprises of 3 of us. We make the decisions on which companies to invest in and how much of the fund we invest in a company. And we also seek opinions from our expert LP base. LP, by LP, I mean the investor base. We have a lot of LPs from the tech industry who are in top positions in big companies like Microsoft, Google, Amazon, and a lot of other tech companies. So we seek their advice and opinion as well while making these, while doing the due diligence on these companies and making a decision to invest or not. So why should you invest in our fund? One, portfolio approach. We talked about overexposure to a single company. If that company does bad, then your entire investment is at risk. So portfolio approach reduces the risk of overexposure to one company. We have an experienced team who has been doing this angel investments and pre-IPO investments for a significant time now. So we do understand how to separate artificial hype from real value, and we know how to go through the process and find that out. And our investment thesis a lot of people blindly invest in pre-IPO companies without knowing the impact on their exit, when can they exit, and how much upside they have. So one thing that even if you are doing individual stock picking, one thing you have to remember is 40% of the Series D plus companies, they never exit, or they don't exit in a timely way, which means you invested your money and there is very low liquidity in this asset class, your money is stuck. So you have to identify the right companies that will exit in the near future. Only then you invest in these companies. And the last reason is co-investment. We also put our personal money in these funds. So we have as much incentive as to grow our money. So we grow our money along with your money. And the carry, we'll talk about carry in a little bit. The industry standard is 20% in this space. We do a 10% carry, primarily because we come from an investor point of view, and we don't want to overcharge you on this. And also our incentives are aligned. If you know how carry works, we get that money only when you profit, not upfront. So we only when we generate profit, we get the carry. There are, I talked about many risks in this space. We'll talk about risks and how to mitigate them. Inflated valuations. Recently, S&P 500 is inflated quite a bit, and that spilled over to the private markets as well. And private assets, pre-IPO assets inflated as well. The valuations are insane. So we want to be very, very selective. We don't want to go after every shiny object out there and invest in it. We'll be very selective, and our goal is to uncover hidden gems, which will do well in the next 3-4 years. So that is the work we do behind the scenes. There are transaction risks because this space is not very transparent, and you're dealing with angel investors, venture capitalists, and employees. They have different deal structures and different terms of the deal. So there is some risk. In the market, there is some risk of fake shares as well. Somebody doesn't have the shares, but they still pose that they have the shares. So the way we mitigate the risk is we take help of seasoned securities lawyers to go through all the documents and really find out if the deal is worth pursuing or not. There are macroeconomic trends. For example, fintech blockchain. The fintech part is okay. There is no big risk there. I mean, there is risk, but it's not very significant. On the blockchain space, you don't know when the government will put tough regulations on Bitcoin and blockchain. So that's the risk you are taking in that space. So there are macroeconomic trends, both in terms of how the government treats certain assets, and also the valuations. For example, if there is a big stock market crash happening this year, then all the valuations will come down. So that is another risk. Because we are going into this with a long-term perspective, that's somewhat mitigated. We will patiently wait until these companies exit. There is also a liquidation risk. Few investments, few companies, they may decide to stay private. Let's say SpaceX has been private for a long time. Just now they're starting to talk about going public. So there will be companies that say, we don't want to go public, we'll stay private. So you might be holding those companies for longer than you would expect. So that's another risk. So I'll quickly walk through our investment methodology, and so that we leave time for Q&A. Our fund structure, general partners, we three, put some money into the fund, and we invite investors like you to become our limited partners, and you put your money into the fund as well. So we take this entire money, and the money goes to 3 different buckets. One is the administrative cost for the fund. You have to pay the lawyers, you have to pay the accountants, you have to pay the vendor who is managing this fund for us, administering this fund for us. Those are administrative costs. And there are transaction costs with each investment. because this is not like a stock market where you get zero commission and all of that stuff. You have to pay the lawyer to do the due diligence on each company to find out whether these shares are real or not. And you have to pay fees. For example, I might go to a big broker dealer and buy shares of a company. They charge 5% fees for that transaction. You have to pay that. In some cases, we might go to a VC and buy shares from the VC. They would say, hey, I need 5% fees now and 20% carry when this company exits. So you pay on both ends for them. So those are all transaction costs, and the remaining money go to the investments. So as I talked about, each fund invests in 10 to 20 companies for the in their respective space. We go with a long-term view. We do all the due diligence upfront so that we pick the right companies and patiently wait until the IPO happens. After the IPO happens, we sell the stock after the lockup period expires. I talked about 6-month lockup period after IPO. We cannot sell it. After 6 months, we sell the stock and return the money to you. So the total fund timeline is 5 years. We may extend it beyond 5 years if there are still companies that haven't gone public and stuff like that. But whenever these companies exit, we sell the stock and return the money to you. That could happen in year 2, that could happen in year 3, that could happen in year 4. We don't have control on that. It depends on when these companies go IPO. But as and when companies return, at the end of that quarter, we return the money back to you. So this is how carry works. Let's say you put in 50K into the fund. Our goal is to first return you $50,000 without taking anything from that. And any dollars we return to you above 50K, we charge 10% of that, and 10% goes to us and 90% goes to you. For example, if you invested in 50K and that 50K became, let's take this example. Your investment is 100K and your profit is 200K, which means you get your first 100K without any charges. Of course, there are administrative costs and all of that. The entire fund pays for it. Your profit is $200,000. We get 10% profit, 10% out of your profit. Your original investment, we don't get anything out of that. If your investment is 100K and your profit is 100K, you get 190K, we get 10K. That's how carry works. In this case, if the profit is lower, we get 5,000, you get 145,000. That's how this is set up. So our incentives are aligned. We want to generate more profit, and when we generate more profit, we get a bigger share of the pie. So I will quickly walk through the process. First, we identify the deals. There are a lot of companies out there. We took all the companies that are sizable, which are close to $1 billion in valuation. There are 1,500 companies. That's our universe. And we spent significant time to research into those companies, basic level of research. What companies are worth investing in, what are not worth investing in. We narrowed down that list to 180 companies in the 4 areas we talked about. One is cloud area, one is transformational area, blockchain area, and consumer area. So we brought the 1,500 list to 180 companies. That is our master list. Out of this list, we intend to invest in 10 to 20 companies through each fund. And then out of these 180 companies, we do deep due diligence on these companies, why this is a good investment. One of the general partners writes a report on why this is a good investment, and the other 2 provide inputs and votes on that. Only then an investment will go through. That is the voting process. And then we invest. We could go to angel investors, we could go to employees, we could go to VCs, we could go to broker dealers. We have several suppliers. We go to them and buy the stock. We execute the paperwork, finish the paperwork, and we wait for the exit. We wait for the company to go IPO. and exit after the company goes IPO. So what are the investment requirements? You decide your check size, how much money you want to put in the fund, and pick which of the 3 funds you want to invest in. And come in with the view of, because these companies, we don't know when they will exit. It could be 2 years, it could be 3 years, it could be 5 years. So part of your investment will be liquid until these companies exit. If these companies start exiting in year 2, you will get your money back. You will start getting your money back in year 2. But if the market is very bad and no company exits, you might have to wait until year 3. You might have to wait until year 4. So come in with a view of this is somewhat of an illiquid investment. You cannot pull your money out whenever you want, like the stock market. When you come with that view, it will be easier. The money may start coming back at year 2, or it could take more time. Needless to say, all the investors in this fund must be accredited investors. And we have a link where you can enter your hard commitment. We'll have that a little later as well. What you will receive an LP interest in the fund. It's a 506c offering. We file with SEC, and you can see in the SEC website our fund and stuff like that, and the size of the fund. You get exposure to 10 to 20 pre-IPO companies. It is completely passive investment for you. We take care of identifying the companies and investing in the companies. And every quarter, you get a fund report, what companies we invested in, what price we invested at, and what is the current market value. Did it go up or did it go down? And a 1-line summary for each investment. So a strong reason to invest in our fund is when we are investing through the fund, we get access to these great companies, and we want to offer those as one-off as well, given that we have supply, if we have more supply. So the investors investing in this fund will get preferential allocation for that. For example, if SpaceX is a candidate for our fund, of course, we need to do the due diligence based on the price at that time, and it still has the upside left and all of that. Let's say the decision is, yes, we are investing in SpaceX, and we have more supply, we'll give preferential allocation for the people that are investing in our fund. And we talked about cash distributions. There is no predefined timing. Whenever these companies go IPO and lockup period expires, we sell the stock and try to return the money at the end of the quarter. We don't return immediately. So you have 3 funds. Which one should I choose? It really depends which area you are interested in. One easy way is, let's say you are trying to invest 100K. I would split between Consumer Plus and FinTech Plus, because that gives you exposure to all the segments. But if you have a favorite segment, no problem. Our minimum is $50,000 investment. You could pick one of the 3 funds and invest in one of the 3 funds. So we already started collecting commitments since early March. Our first round of commitments, we already have a good level of commitments there. The second round of commitments is closing on Monday, which is tomorrow. So you need to commit to the fund by tomorrow, but the money is due only 15th April. You don't need to transfer money tomorrow. You need to commit to the fund, and then you can transfer the money on 15th April. So that's all from our side. Thank you so much for patiently listening and understanding the pre-IPO asset class. I will leave this slide here. There is a lot of contact information on the top left. If you want, if you want to join one of our funds, go to this link, vibhu.vc/AAPI. We made a special link for you guys. So just go there, enter your commitment for the fund. You're all set. We'll contact you how to transfer money and when. If you want to join our WhatsApp group where we will share these funds and any future deals, we highly recommend you join this so that you stay connected with us and you get information about our future deals as well. You can also follow us on Telegram, where we publish startup news, what's happening in the tech world and in the pre-IPO space. And if you have any feedback or questions, you can email us at info@vibhu.vc. I will leave this slide and open up for Q&A. Hopefully, the presentation was informative, and we'll take Q&A now.
Excellent. Thank you. Thank you very much, Satya. Indeed, very informative. And members, please take the advantage of asking some questions. And I'm sure you already put a slide for us, AIP slide with Vibhu. And please log in and get the advantage. Thank you. How long are you in the business, though?
So, yeah. So we started personally investing in pre-IPOs probably in 2017. So that's how we have been, investing in this space. Formally as a brand last year, 2020. Yeah, 2019, we did not have a brand. I told 2019 we raised a fund. We invested in 30 pre-IPO companies. That was a trail run for us. In 2020, we formally formed a brand and invested in SpaceX about $4 million.
Satya, ask your partners to say a couple of minutes, whatever they want to say.
Sure. Yeah.
Happy to. So I'll probably use the time efficiently. This is Kalyan. What I would probably do is there are some very, very good questions coming up in the chat. So number one, apologies on the timeline. We should have known better about AIPI much early and should have connected with you guys much early, given you this education, given you the time. So this was organically coming up on us. We did want to take the opportunity to introduce our methodology, our investment thesis, and spread the word out there on the existence. Totally understand that the timeline is very short on you, but this is probably what some of you who want more comfort with us, right? This is probably what I would recommend. https vibhu.vc/join. If you were to go hit the link, give us some basic information and join our WhatsApp group, you can be added to our community. You can watch how things are happening over a period of time, build your confidence and trust on us, and go ahead with some of your investments. In terms of, so let me also take a few questions, or maybe Shankar, you want to take a few, and I'll look at all the questions here and try and answer some of them.
Sure, Andy. It's pleasure participating and then taking the questions from you all. The questions were mostly around how does the carry work and what about the cost? So the costs are, for example, like if there is any expenses that are there as part of the transaction, those are already taken care by the time we return your profit. So, for example, you invest 50K, and there are some certain costs. There are certain costs. So when we get the money back, we would start returning. We would return all your 50K, and then if there are any costs, the returns would cover that. Satya, if you want to add anything else, like on the cost, please do that.
Yeah, the costs, as I told, there are administrative costs, there are per investment transactional costs. Yes, so the way to look at carry and the tax impact, right? So you are putting in 50K, you get your 50K back, that is return of capital, and whatever is returned above that to you, that is your profit. So, so yeah, that's how it works.
So the next question I would take is like, are you registered in the US as a VC firm, and what has been your track record return so far? So this is a frequent question as well. As Kalyan answered on the chat, in 2019 fund, we got a return of around 2.5%, 2.5 times the investment. Out of the 30 investments, 8 of them have seen an exit, and 22 of them we're still expecting. Are you registered? So we had different names, and our new branding is Vibhu VC. If you search for tech unicorns, you'll find some information on SEC. So that is something that you could find.
So there is, and I'm not going in the order, and I'm probably going last and first out here. So what are the negatives and what are the cons? I believe this is primarily about of investing into pre-IPO. Like Satya talked about, this as a very lucrative channel of investment, but subject to market conditions, these could have risks associated in it in terms of some of the companies not going to public, some of the companies, I mean, our favorite example is if you heard about WeWork, it was a co-working space that was founded, was supposed to be a 20, 30 plus $billion company in 2018, but COVID hit. Their management turned out to be non-reliable. The valuation is now down to 8 billion, I think. That is the latest we have heard. So there could be investments like that. But we strongly believe in the fund approach here, being how to work around this or still stay afloat. So let me take a
We have a couple of people that raised their hands. Should we?
Yes, please. And I'll scan through the questions.
Yeah. Sridhar Somsettigar, go ahead.
Can you unmute him, please? Vijay, can you unmute Sridhar Somisetti? Vijay? Yeah, go ahead, Mr. Somisetti.
Yeah, thank you. Thank you. It was a good talk. I have a question. So I consider investing into your fund like investing into a mutual fund or an ETF. So the question is, will we ever get the actual shares into our portfolio, or is it only the profits that we get out of that? Number one. Number two is, what are the downsides? I see the advantage of diversification by doing.
My hand is up. So
we see the advantage of the diversification with the fund approach, but we always imagined that getting into the pre-IPO was that we are going to own the shares. So I would be happy to own the shares of Snowflakes rather than just be in a fund and not really see the shares in my pocket. Thank you.
I can probably take that. So this is, Satya probably touched upon it during the presentation. So fund is not the only way for you to invest. So fund is an awesome way for you to diversify your allocation. Along the way, when we are actually acquiring positions for the fund, what we also intend to do is open up dedicated investments into the companies that have been shortlisted for the fund. Example is SpaceX, right? Almost anyone and everyone who has seen Tesla, what Elon Musk has been able to do and believes in the potential of space wants to invest early into SpaceX, right? So when if SpaceX happens to be one of the company that we are investing from the fund, what we certainly will do is come to our investor base and tell us that we are working on a deal for SpaceX and ask you guys as to how much additional investment you want to put in SpaceX, right? If you go tell us, we will try and secure supply for the additional investment, and that additional investment is what we give you an option to either liquidate or take over the shares once the company goes public. For the fund, we have this, so that there has to be a structure around it, right? So the number of shares that everyone gets, because of how the fund is structured, you might only get a small portion of the shares, and we always have this policy of exiting at the first available liquidity event. So the other way for you to look at it is, that, for example, this particular company, like Snowflake in your case, right? We invested 5,000 as a part of your 50,000 into Snowflake. It hits IPO, hits a liquidation event. You know what your 5,000 has become and how many rough shares you would have acquired through the fund. The fund will exit them for you, but you know how much cash you are probably getting back. And you can always go put that money into the market at that point in time, if it is a particular thing through the fund. And know that you have taken the return on your early investment and have reinvested at the same price. I hope that answers your question, sir. And again, something that we probably talked about, but want to re-emphasize, the supply for these investments are generally super tight. So when we do secure the supply for our fund and any additional supply, we will prioritize additional allocations to our fund investors. So being a fund investor comes with this added advantage of being on the priority line for getting supply. There were some of you who asked us, hey, what, references and things like that. We are currently close to around 400 plus investors. We have investors from the IT serve community, which is all the IT companies of Indian ethos. We have investors from all the major tech companies in US. So if we were to catch up offline, we'll see if there are any common references through Facebook or LinkedIn that you and us have, and we can always have you have a conversation with them. Then there are a series of questions around IRA. I think some of it has been answered here. So SEC restricts us from taking. SEC has put limitations on us as to how much money we can raise from IRA. I believe the limitation is if we have a 2 million fund, 25% of it can only come from IRA investments. We still have some IRA spots available. So if you are looking at investing through IRA, please reach out to us soon. We will be able to try and facilitate that.
Yeah, to add to that, your IRA provider has to allow you to invest in private placements. If your IRA provider allows you to do that, you can invest through IRA. Typically, that would be a self-directed IRA.
There are some questions around investments into Indian companies, Indian startups. So for this fund, I see Shankara Garu has answered. Most of our focus is US-based companies, but we are certainly looking at Indian-based startups as well, and we might have some of those opportunities showing up, and Byju's is certainly on our list.
So actually, shall we give opportunity for Kamalakar Garu and then Dr.
Yes,
yeah.
So, hi, thank you. It was a very good presentation, Andy, and all of you Telugu people, nice. One of the things is, how do you separate yourself? I know Aon Investments where they do the same thing, and pre-IPO late stage funding. I've invested with them also. I know the whole structure. How do you separate yourself, or how do you distinguish yourself from other ones who are in the similar space, number one? And number two, if somebody has retirement plans such as a profit sharing plan directed, will they be able to also invest that money into these venture funds of yours?
Sure. That's a good question, Andy. Regarding the first question, right? How are we different? Typically, these kind of funds, they come with a yearly management fee, which is in the range of 1 to 2%. We are not doing any management fee. So our management fee is zero. As Satya Garu also mentioned, the carry is typically 20% in the VC's world. So we are doing a low carry of 10%. Then we are co-investing. So we make money only when the fund profits. So that would be the first answer for the first question. Say the second question again. What is the second question?
The second question was, you said self-directed IRA, but some of us have like profit sharing plans. Whether we could invest through the retirement funds, that's number one. And secondly, just follow up, if you already have funds locked in other companies with the pre-IPO stage in individual companies, is there a way of transferring them to you, or we have to leave it where it is with those companies? Obviously, I think we have to leave it with them. I don't know, but is there any transfer like HIPAA portability stuff?
So essentially, this is called a private placement memorandum. Like if your retirement provider allows you to do private placement, and then the money has to come to us. And then as Kalyan and Satya has also mentioned, we can manage only 25%. So they're limited spots. For example, we may raise 10 million, only 2.5 million can be from IRA accounts. So if you reach out to us, we'll tell you like if there is enough space for IRA. And then we could do it on an individual basis for your specific situation. Dr. Sampath, would you like to go next? Please unmute yourself.
Yes, okay, thank you for the opportunity. My question is limited to SpaceX because I think that's going to be the hottest IPO coming in the next months or years. How much access do you have to SpaceX shares, and how can we prioritize for IP Group? Can you please explain?
So we still have one of our partners who has access to SpaceX. We will bring it up in future, but we can't exactly say when and how much it will be. If you join our group and then if you're part of the fund, you will get preferential allocation. But if you join our group, we will let you know if there is any opportunity for that.
So just to add to that, SpaceX happens to be one of our favorite investment. We will continue to find supply for it any number of times that is available in the market, and we'll continue to bring it to the market. Bring it to our investors.
I think, is there any, can you prioritize? Because many companies in California offering IPO shares for $980 right now. I mean, if you can assure us that you have enough supply of this IPO, we can go ahead and lock them up.
900.
We don't 980. So the last one we did was about 1 month back, and it was at 530. 2 months back, it was at 352 plus. Both cases there is carry associated. So in terms of supply, yes, we are actively working on additional supply. And if there is supply available in market, we probably can claim to be in the best position to get supply. Do I have it today? No, but I should know about the next tranche of supply in the next week or two.
Thank you so much. I appreciate it.
Somebody raised hands.
Mr. Suresh, would you like to ask?
Yes, thank you very much. It's really an excellent presentation. I got most of the information from previous questions and answers, but I wanted to verify first of all, you have to be an accredited investor. And the second thing is, do you have to invest in your fund first in order to invest in an individual company? That's the one thing. Or can you just request for just investing in an individual company? And also the second thing is, if you wanted to invest in an individual company, is there a minimum amount that you have to?
So the first one, so we give preference to the investors who participated in our fund whenever we have a one-off opportunity. And then if there is additional supply left, we will give it to other members are part of our group. Like, so when you join this vibhu.vc/join, you would become one of our member. So, and then if you participate in the fund, you will get the first preference. Regarding specific minimums and availability, it really depends on the fund. Typically, it's around $10,000 on individual opportunities.
Thank you.
And Kamalakar Garu, you had one more question. Please go ahead, unmute yourself.
Yeah, you didn't, I was wondering, are you participating in SPACs at this time, or can you expand on that, the SPACs?
So I'll let Satya take that.
Yeah, SPACs, no, we are not. So we believe in identifying these opportunities somewhat early and patiently hold them through the IPO. We don't want to run after SPACs and get into the speculation mode. So no. So our universe is look at Series D plus companies, which are have at least $1 billion in valuation or close to $1 billion in valuation, and research about that company, why it is a good investment, and invest in it. So yeah, that's our investment philosophy. No, we don't want to run after everything, every SPAC in the market.
Any other questions? Like, feel free to ask now, because what happened was, like, we may have missed any of your questions on the chat.
Yeah, so there is a question on group investing that came up as a direct investment. This is something we have generally seen. I mean, a few of you who might have done some joint investments before, wanting to explore this as a group. Yes, we do take group investments through LLCs, but there are certain limitations that SEC has on us, which is the amount of investment you are bringing in through your LLC cannot be more than 40% of the total investments through that LLC. What it means is, if let's say you want to bring in $50,000 through that group LLC, you have to have at least assets of $200,000 in that LLC, or have commitment to go invest an additional 100 and actually I might be wrong on my math. Okay, yeah, roughly around that, right? So you have to have commitments for additional investments through that LLC, and that is when we can take the group investment. The LLC cannot be formed for investment into this. You have to have more investments you have to make through that LLC, in short. I see Suresh Garu has his hand up, and Sundarji has his hand up. Let's go to Suresh Garu.
Oh, sorry. So I want to understand what are your exit criteria for each company that you invest in? And the second thing is, when do you actually return the investments? Like each company that you exit, you're going to be returning that part of the investment?
Yeah, it's a good question. So in terms of exit criteria, the liquidation event is our exit criteria for the individual investments. What it means is there are some that could get acquired, which means you have an immediate exit. There are some that could go SPAC, which means you have almost an immediate exit. Then some you have IPO, the traditional IPO event, which means the lockup expires 6 months after the IPO has listed. So when any of this event occurs, that is considered as an exit event for that company. So in the quarter that this lockup expired or a liquidation happened, you will get your money back on that particular investment. So we pool all of the exits that happened in that quarter, and we will return the money in that quarter, subject to the carry.
Alcaraz is not answering. Can you tell her to call 5069, please? Text her.
Kalyan, we have a couple of more questions. We can wrap up.
Yeah, sure. I see Kamlakar ji has his hand up for a while.
Actually, should we give Selvaraj ji, like he has been waiting?
Sure.
I have three questions. Number one, where are you located? Meaning, where is your company located? Number two, who is the financial institute holding our funds? Number three, what are the pre-IPOs you are offering, like Instacart or Impossible Foods? Are they available now?
We are located, yeah, go ahead, Satya.
So the firm itself, it will be a Delaware company, and the place of business will be North Carolina, where Shankara lives. The funds, they will be Delaware LP. Sorry, the funds will be Delaware LP GPs. So V3 will be a GP entity, and all of the investors will be an LP entity. The LP entity has limited liability. So all these entities are in Delaware, and we will file all these entities with SEC, where you can see the company name, how much money was raised, and stuff like that. We do use a very reputed player in the fund administration space. They are called Assure. So we use Assure to administer the fund. Assure opens a bank account for this, for each of the fund, and all the money will stay in that bank account, which is specific to the fund. How money is used from that bank account is either it's an administrative cost, which means we pay to Assure, or we pay to a lawyer, or we pay to an accountant, stuff like that, or it is used for a purchase. So Assure moves money out of that only with a purchase agreement. When so we need to give them, hey, here is the purchase agreement, here is the amount, transfer the money now. Only then they would transfer the money to that party.
Last question, please.
Hello, this is Kamlakar. Can you hear me?
Yes, please go on.
Somebody asked about exit strategy. You don't say, for instance, somebody is in a dire necessity to sell or cash out their money. Do you have a vehicle where somebody else, some other member is interested in buying them and giving and cashing them out? Say for instance, somebody is terminally ill, sick, or they need to cash out the money that they have invested with you. Do you have a vehicle where you could find another member who is interested in acquiring that thing and help them to get their money out?
We got it. Actually, we can facilitate that transfer. If you find the buyer for a small fee, our provider will facilitate that transfer.
Yeah.
That is possible. That's possible, but it's not preferred, but it's possible.
No, I mean, in the dire necessity of selling, you know, there are so many circumstances where people would like to, if possible. I know once they are stuck until 6 months until the IPO goes, then only you can cash out. But in other instances, those who don't have long lifespan, they may want to cash out earlier if they have to. Thank you very much. It's an excellent presentation. I really commend all three of you did a wonderful job.
Thank you.
so much.
Satya would like to close with all the references.
Yeah, and maybe I just want to say one thing. I know we haven't had the amount of time to answer all of your questions, and we know it is coming in too short when we are about to close. For AAPI, on behalf of the team, we would love to first thank you. Number two, if you were to join the WhatsApp, join us at vibhu.vc/join. We will stay in touch with you. And if there are some of you who would want to connect with us offline, we are happy to reach out to you either on phone or maybe schedule a follow-up for some of you together or do whatever to give you more comfort. But we want to make sure you have all the information you need and you get all the confidence and trust in us before you make your investments. Satya, you want to take over?
Yeah, I think, feel free to, just like Shankar said, feel free to take a screenshot of this thing. All the links are here. Yeah, thank you for this wonderful opportunity to present to the AAPI community. We would love to work with you. Please reach out to us. We are happy to answer any questions. Yes, this could be somewhat of a new space for many of you. Happy to answer any questions and take it from there.
Yeah,
Thank you.
maybe sorry, and just one last thing. Maybe it is best to take the 5 minutes now before you forget. Go join the group so that you can stay connected with all the happenings. And some of you had questions on availability of certain of this companies. We will keep you posted in the WhatsApp groups. Sorry.
That concludes the program. Thank you, Vibhu Ventures. Thank you, Sankara, Satya, and Kalyan. And definitely, they will come back and give 2 more talks in future webinar. And good morning to everybody. Stay well. Bye-bye.
Thank you all.
Thank you all.